Hello guys, this is Finance Balance. Welcome to my YouTube channel. Did you know that even the pros struggle to time the market perfectly? It's a common misconception that professional investors have some secret formula or insider knowledge that allows them to predict market movements with pinpoint accuracy. The reality, however, is far different. It's true. Many professional investors believe that consistently predicting short-term market swings is nearly impossible. They spend countless hours analyzing data, studying trends, and using sophisticated algorithms, yet they still find it challenging to beat the market consistently. This is because the market is influenced by a myriad of factors, many of which are unpredictable and beyond anyone's control. So if the experts can't crack the code, what does that mean for individual investors? It means that we need to rethink our approach to investing instead of trying to outsmart the market, which even the pros struggle with. We should focus on strategies that are proven to work over the long term. This involves understanding the fundamentals of the companies we invest in and having a clear investment plan. It means that instead of trying to outsmart the market, we need to focus on strategies that work over the long haul. Long-term investing is about patience and discipline. It's about buying and holding quality companies that have strong fundamentals and the potential for growth. This approach allows us to ride out the market's ups and downs without getting caught up in the daily fluctuations. Instead of searching for the elusive perfect entry point, we should aim to buy great companies at reasonable prices. Timing the market is incredibly difficult, if not impossible. But by focusing on the value of the companies we invest in, we can make more informed decisions that are likely to pay off in the long run. This means doing our homework, understanding the business models, and looking at the financial health of the companies. This approach takes the pressure off trying to time the market perfectly and allows us to focus on the fundamentals of investing. By concentrating on the long-term potential of our investments, we can build a portfolio that grows steadily over time. This not only reduces stress, but also increases our chances of achieving our financial goals. So remember, investing is a marathon, not a sprint. Focus on the journey, not just the destination. We've all heard the saying, buy low, sell high. Sounds simple, right? The idea is to purchase stocks when their prices are low and sell them when their prices are high, making a profit in the process. It's a concept that seems straightforward on paper, but in reality, timing the market is anything but easy. The stock market is unpredictable, and prices can fluctuate wildly in a short period. What seems like a low price today might drop even further tomorrow, and what appears to be a high price might continue to climb. It's like trying to catch a falling knife. You might get lucky once or twice, but eventually you're going to get burned. The risks are high and the potential for loss is significant. Many investors have found themselves in financial trouble by trying to time the market. The stock market is a complex beast, driven by a multitude of factors, from economic data to geopolitical events. News headlines, government policies, and even natural disasters can influence stock prices. The interconnectedness of global markets means that events in one part of the world can have ripple effects elsewhere. Trying to predict how these factors will interact and impact stock prices in the short term is a fool's errand. Even seasoned investors and financial experts struggle to make accurate predictions. The market's behavior can be erratic and counterintuitive, making it nearly impossible to consistently buy low and sell high. Instead of chasing quick profits, we need to adopt a more measured approach. Long-term investing, diversification, and a focus on fundamental analysis can help mitigate risks. By understanding the companies we invest in and holding on to our investments through market fluctuations, we can build wealth over time. Patience and discipline are key to successful investing. One of the biggest challenges investors face is market volatility. One day the market is soaring, the next it's plummeting. These wild swings can be nerve-wracking even for seasoned investors. Economic indicators like interest rate hikes, or inflation reports can also inject uncertainty into the market. These announcements can trigger both positive and negative reactions, making it difficult to predict their impact on stock prices. This unpredictable nature of the market is why a long-term perspective is essential. Before you even think about buying a stock, you need to do your homework. This means understanding the company's business model, its competitive landscape, and its financial health. This process is called fundamental analysis. Look at the company's revenue growth, earnings per share, and debt levels. Are they consistently profitable? Do they have a strong track record of innovation? These factors can give you insights into the company's long-term potential and help you determine if it's a worthwhile investment. In addition to fundamental analysis, it's also crucial to consider market trends. What sectors are performing well? Are there any emerging industries that present investment opportunities? Technical analysis, which involves studying charts and patterns in stock prices, can also provide valuable insights. By understanding market sentiment and identifying potential support and resistance levels, you can make more informed investment decisions. Section 6. Your money, your goals. Aligning investments with aspirations. Investing isn't just about picking winning stocks. It's about aligning your investments with your financial goals. Are you saving for retirement? A down payment on a house? Your investment time horizon and risk tolerance should dictate your investment strategy. If you have a long time horizon, you can afford to take on more risk. However, if you're nearing retirement, you'll want to prioritize capital preservation. Understanding your financial goals will help you determine the appropriate asset allocation for your portfolio. Section 7. The Buy Checklist. A step-by-step guide to smart investing. To help you navigate the complexities of stock picking, here's a simple checklist to guide your decision-making. 1. Do your research. This is the foundation of any smart investment strategy. Without proper research, you're essentially gambling with your money. Start by gathering as much information as you can about the company you're interested in. Look at their annual reports, press releases, and any news articles that mention them. The more you know, the better equipped you'll be to make an informed decision. Conduct thorough fundamental analysis of the company, understanding its business model, financials, and competitive landscape. This means diving deep into the company's earnings reports, balance sheets, and cash flow statements. Look at their revenue growth, profit margins. Also, consider the company's competitive position within its industry. Are they a market leader, or are they struggling to keep up with competitors? Consider market trends. Analyze the performance of different sectors and industries, and identify potential growth areas. This involves looking at broader economic indicators and trends. For example, is the technology sector expected to grow in the coming years? Are there any emerging industries that could offer significant growth opportunities? By understanding these trends, you can position your investments to take advantage of future growth. 3. Assess your financial goals. This is a crucial step that many investors overlook. Before you invest, you need to have a clear understanding of what you're trying to achieve. Are you saving for retirement, a down payment on a house, or your child's education? Your financial goals will determine your investment strategy and risk tolerance. Determine your investment time horizon, risk tolerance, and how this investment aligns with your overall financial plan. Your time horizon is the amount of time you expect to hold an investment before needing the money. If you have a long time horizon, you can afford to take on more risk. Conversely, if you need the money in the short term, you'll want to be more conservative. 4. Start small, diversify. Don't put all your eggs in one basket. Diversification is one of the most important principles of investing. By spreading your investments across different companies, sectors, and asset classes, you can reduce your risk. If one investment performs poorly, others may perform well, balancing out your overall portfolio. Spread your investments across different companies and sectors to mitigate risk. 5. Be patient. Investing is not a get-rich-quick scheme. It requires time, patience, and discipline. The stock market will have ups and downs, but over the long term, it has historically provided strong returns. Remember, investing is a marathon, not a sprint. It's important to stay the course and not get discouraged by short-term market fluctuations. Stick to your investment plan and keep your long-term goals in mind. Don't panic sell if the market takes a downturn. Market volatility is a normal part of investing. Instead of reacting emotionally, take a step back and reassess your investment strategy. Are your investments still aligned with your financial goals? If so, stay the course. If not, make adjustments as needed. Stay focused on your long-term goals. It's easy to get caught up in the day-to-day movements of the stock market, but successful investing requires a long-term perspective. Keep your eyes on the horizon and remember why you started investing in the first place. By following this checklist, you can approach stock purchases with a more informed and disciplined mindset. This will not only help you make better investment decisions, but also give you the confidence to stick with your investment plan through good times and bad. Happy investing. Section 8. The bottom line. Knowledge is power in the stock market. While perfectly timing the market is nearly impossible, understanding the fundamentals of investing can significantly increase your chances of success. Thorough analysis combined with a long-term perspective and a clear understanding of your financial goals is the key to building a profitable portfolio. Remember, investing is a journey, not a destination. There will be ups and downs along the way, but by staying informed and sticking to your plan, you can weather the storms and achieve your financial aspirations. Section 9. Join the conversation. Share your thoughts. What are your biggest challenges when it comes to timing stock purchases? What strategies do you use to make informed investment decisions? Share your thoughts in the comments below. And be sure to check out our other resources on investing and personal finance. Thank you for watching. Don't forget, like, comment, subscribe, and press the notification bell.